All right, we're ready. Okay, welcome to Business and Leadership, Accounting Best Practices and Tax Essentials, plus highlights from the big, beautiful bill. My name is Matt Roselle. I'll be your moderator today. I'm a brewery insurance broker with the James F. Sutton Agency, as well as the Operations Director of the Long Island Brewers Guild. Our speakers today are Erika Stork and Kate VanBramer. Erika Stork, CPA, is the Senior Manager on the advisory team of MMB+CO in Rochester. She works with business owners who want clearer financial systems and more confident decision making. With more than 20 years of experience in tax, accounting, systems, and advisory, Erika helps businesses move from financial chaos to clarity, whether that means cleaning up messy books, improving systems, supporting growth, or preparing for a future sale. Earlier in her career, she gained corporate finance experience working at a leading investment bank in New York City. Erika is passionate about helping business owners feel supported and confident in their numbers so they can focus on leading their companies. Kate VanBramer, is a partner at MMB+CO in Rochester. Kate brings over 20 years of experience in public accounting and serves as a trusted advisor for businesses and individuals specializing in both audit and tax services. As a partner, she leads engagements that ensure financial accuracy, regulatory compliance, and strategic tax planning tailored to each client's goals. With no further ado,
Awesome.
Here we are.
Stick up here and try to keep everybody awake. Like I had said, we have a nice, small, intimate group here. So you've got two CPAs at your disposal, so feel free to ask questions. We're happy to help you in any way that we can. The reason that we're here today is to demonstrate for everyone how having a disciplined approach to your day-to-day accounting and maximizing your tax strategies and planning can increase your bottom line, your net income, and improve your cash flow. So, I think that that's a goal for everybody, right? More net income, better cash flow. So that's what we're working for today. I'd love to hear anyone's questions or other tips or tricks. Yep. So feel free to share as we go. So we're going to today cover the current financial landscape of breweries, which you're all familiar with already, financial insight signals of a healthy brewery, accounting practices that support better decision making, tax planning under the One Big Beautiful Bill Act, so those are the new tax changes that came through this year, and key New York State tax provisions. We'll have time for Q&A, but again, feel free to ask questions throughout. All right, so we'll start out with accounting best practices. So the reality of the challenges that breweries are facing, right? I don't have to tell you, changes in demand, increased costs, ingredients, materials, labor costs, distribution margins. It can feel like, you're up against all these challenges and the cash in the bank is getting tighter. So what we're going to do today is kind of show you the insights we see as the CPAs, right? We have a wide variety of breweries as clients. So we have that we do taxes for, accounting for, and so today we're hoping to kind of share for you two pretend companies, just profiles, to show the difference of one that is profitable and one that is struggling. And what we kind of see from those two breweries, their profiles, how the owners approach their accounting, the discipline that they have, and what their process is like. So we have Black Ink Brewing and Red Tide Brewing. So both are New York craft breweries, similar in size, similar in market, and we'll just assume similar quality beer. Okay, so at first glance, which brewery would you rather own? Black Ink Brewing has steady taproom traffic, fewer beers on the menu, and limited distribution. Red Tide Brewing has higher revenue, expanding distribution, and constant new releases. So most people might pick Red Tide Brewing, but we'll see. We'll see which one you choose. Okay, so meet the Black Ink Brewing team. We have the owner, Ben Ledger. The team, we have Paige Balance as the controller, Mason Yield is the head brewer, and Tara Tapp is the taproom manager. So Ben, as the owner, his philosophy is breweries are a creative business, but they're still a manufacturing business. Now we can meet the Red Tide Brewing team. So the owner is Mike Margin. His team has Sally Short, part-time bookkeeper, Chad Poor, the brewer, and Dylan Draft, the sales manager. So Mike, his approach is we need to sell more beer, and so he focuses on sales. Both breweries face the same pressures, right? What do most owners do when they face these pressures, right? This current challenging environment. Everyone approaches these pressures different. So we're going to look at two different possible reactions from owners. So for Black Ink, Ben says we need better visibility. We need to understand the numbers. I need to get a better handle on the finances. And then Mike says we need to sell more beer. And that's his approach, to focus on the sales. There isn't one clear answer, by the way. I don't have to tell you that. These are just two profiles to explore. And so if we look at the financials, right, of Black Ink and Red Tide, Black Ink has $2.9 million in revenue. Gross margin is 63%. So gross margin, I know there's some accountants here in the room. Revenue minus your cost of goods sold divided by your revenue. We have cost per barrel of $142. Inventory turns, we're going to get into this a little bit more. Inventory turns 8. So it means inventory turns over 8 times in the course of a year. Inventory value, $135,000 in value, sitting in the cooler. And cash runway, 5 months. So that means that if there's, so cash runway is how long you can make it with your existing cash based on your average monthly expenses. So if you had $100,000 in the bank and your average monthly expenses were $50,000, your cash runway would be 2 months. Now when we compare that to Red Tide, we see that the top line revenue is higher, so $3.3 million. Gross margin is 44%. We're going to get into why that's a little bit different. Cost per barrel is a little higher, $195 per barrel. Inventory turns are only 2.7, so that's a big difference. We're going to look to see how that plays out. Inventory value, $420,000, so it's a lot of inventory. And cash runway, 6 weeks. So, Red Tide does sell more beer in the example. So one of the key differences we see here, and every brewery is going to be different. This is just an example of just one of the different mixes. But here, Black Ink Brewing drives more of their revenue from taproom sales, and Red Tide Brewing more from distribution. So both breweries sell great beer, but where that beer is sold can have a huge impact on profitability. So where does most of your margin come from? Anyone want to contribute?
Our taproom.
Taproom?
Distribution.
Distribution. Yeah, so this is not we're making two examples here, but that's not always going to be the tried and true way to profitability. Distribution. Anyone else want to share? Taproom? Distribution? Yeah. And was it always the case? Was that always the case? Yeah. Well, yeah. Brooklyn Brewing's been around a long time, so. So there could be this distribution, right, trap. And so this is just one example, and this is something that we would look at in the numbers, right, and be evaluating. Every brewery is going to be different. But in this example, so $7 a pint for the tap room versus $170 per keg. So just pointing out that volume doesn't necessarily equal margin. All right, so here's Mike's problem. Cash runway 6 weeks. 420,000 tied up in inventory. So what should he do? He could launch another beer and try to increase revenue. He can push more distribution, right, from his existing inventory. He could review inventory and margins, or hope summer fixes it. Which, I mean, there is a cyclical nature, right, for sure. I think summer fixes a lot of things for us. I don't know if it'll make old Mike's problems go away. Anyone have a what would you do?
C.
Yeah, and review inventory margins, and that's what we're gonna look at. So if we think about the cost per barrel, right? There's obviously the quality of ingredients, and there are certain things that will determine the cost. But outside of that, there's things like waste, inefficiencies, packaging loss, and lack of tracking. Those things could be a part of what is driving up Red Tide Brewing's cost per barrel. And those are the things that, that's what we're going to be looking for and trying to track and quantify to see. Those are the things that we'd want to be bringing down to increase profitability in tracking. Cash in the cooler. So, we saw here that 420,000 in inventory, right? And I mean, inventory is one of the most challenging areas, at least from my perspective with breweries. I see those end of year adjustments that need to be made, right? If we're not adjusting inventory all year, and then all of a sudden we go to see what inventory is, and we're running everything through cost of goods sold, and now we have to make an adjustment, and that can really impact your net income. And
Is that like a book accounting you're doing, or tax accounting for folks? Are people that are under $25 million tracking inventory and taking inventory on a federal return?
Yeah, so, you do need to track, how you track inventory will be different. There isn't a requirement to be under that amount to be reporting your inventory, but by the end of the year on your taxes, you will have to have what your inventory balance is on your balance sheet. And so that's when reality hits at that stage. And so that inventory amount, it's not just beer that's sitting there. That's all the costs, all the money that went out of the brewery to pay for that, to produce that beer. That's where all the cash went, right? So for where's all the cash? It's sitting right there in the cooler. And so that's where when we first started talking about inventory turnover, that's why that's such an important area to be focusing on and keeping tabs on. So problems with inventory, these are some things that can contribute to it. So too many SKUs, so too many different beers, overproduction, slow-moving beers. You may have a sense or of what's moving slow from the tap room or from sales, but there's a difference between going with our gut and what we think is happening and then actually seeing the numbers. You tend to see in the numbers sooner. And so, right, we mentioned complexity can be expensive. So by continuing to add to the different beer selections, that could be a reason that inventory has grown. So if it's not the beer, then what can make that difference in the bottom line? And realistically, it like every day in the accounting part of the brewery, there's many things to deal with, right? There's payroll, there's bills that come through, there's shipping issues, supplier issues. There's never going to be just this like lull where you're just going to be able to just sit down with the numbers and just, yeah, it's always going to be something. So how the owners of the brewery decide to prioritize looking at those numbers and holding their team accountable to have these different financial metrics available to them is what really sets a brewery apart, and that's what we see. So we have Ride Tide that, you know, is focused on the day-to-day and putting out fires here and there, and isn't looking at the big picture. Maybe doesn't have their monthly financials or doesn't have them timely to see even like a P&L or a balance sheet. Maybe their bookkeeper, who is the part-time bookkeeper, is also playing other roles. So maybe they do a little bit of marketing, maybe they do a little bit of, you know, helping in the tap room, and, you know, sometimes those are more exciting. So maybe the bookkeeper isn't reconciling accounts, right? Because they'd rather jump into some of those other roles. So, but you know, it's the owner. If we see the owner put those deadlines on their bookkeeper or on their accountant, have clear expectations of what they need, the type of information they need, all that makes the biggest difference in having that financial visibility. So Black Ink, he makes it a priority. He has set due dates for his bookkeeper and his controller, so he has the information that he needs. So that's what we started to talk about, the different habits that we see a brewery owner who is doing well, profitable. These are the types of accounting behaviors, financial behaviors that we see. So setting a monthly close, regular date that it has to be closed. Like, I mean, for example, by close by day 10, I mean, I think it's very reasonable to have it even much sooner than that, too. If you have a bookkeeper or an accountant that is keeping up with transactions and the accounting weekly, then it shouldn't be such a drawn-out monthly close where you have to wait 10 days to, or longer, a month. I know it goes even longer sometimes, to just get that financial information, even just know how you did in the past month. But it's going to be the brewery owner that has to really set that line in the sand and those expectations. Because what I see is if no one's setting those expectations, then it just doesn't happen.
And Erika, I'll put a plug in for your tax accountant. I feel like the more consistent you are, it really starts with a tone at the top, like you were talking about, but the more consistent you are throughout the year, then you're not rewriting the numbers at year end as part of that tax process and coming up with reports that are usable, trying to figure out, oh, what was that I capitalized, and what am I using that for, where did that invoice go? It's just trickling down to the organization, the organized of the organization, you know, to have that readily available. So if you're diligent throughout the year, that's going to make the year-end process go so much smoother.
Absolutely, absolutely. And, you know, everyone has different inventory tracking. Some have, you know, you might have real-time inventory, or it may just be like a monthly count. You know, we see some breweries where it's just at the end of the year. And so, you know, you really lose the visibility all year long of what are your true, how can you determine your inventory turnover? How do you know what the cost per barrel is if you're not making that inventory adjustment each month? Because there'll always be, it's very normal and expected to have an inventory adjustment each month. There's going to be always some waste, right? Some scrap. So you're going to be purchasing all the different costs are going to go into your cost of goods sold throughout the month, and it may not all 100% end up in inventory. So we would expect to have that. So I would say at least a monthly adjustment for inventory, physical tracking, cost per batch tracking, owner financial review. So just like anything we want to, I guess, have a better handle on, or anything if we want to improve, if we want to improve our health, if we want to spend more time with our spouse, whatever it is that we decide is really important in our life and we want to see results from, it takes a commitment, right? It takes a decision that this is a priority. And I'm going to put this above other things, because there's always going to be fires to put out. There's always going to be something that gets in the way of spending a little bit of time looking at your numbers. So whether it's setting it in your calendar, having a team meeting so that people, maybe it's the brewery owner with the brewer and, some other people on the team that all look at the numbers together to be able to answer questions. Maybe it's having your accountant involved. So that's like one thing that I do is sometimes, especially a newer brewery or a business that is learning how to read those financials, right? What they mean, how they all are connected, the balance sheet, the P&L, the cash flow. Having one of your advisors there with you to walk you through it, like what does this mean, and help you come up with some suggestions. Could be like a nice way to get started. So, right, many owners will push accounting to the bottom. It's something that you can do tomorrow. You can do the next day. It's not maybe right in front of you that you have to deal with. And if it's never made a priority, then that's what happens, is you don't have that information that you need. Making it a priority gives you the reports, visibility, and additional planning you'll be able to do. It's pretty exciting right now in the accounting world because we have some really great automations that are available. There's AI tools. I don't know if anyone went to the AI session, but all of these things that are available now and that are going to continue to evolve are going to help all of you with your breweries. But if you don't have the data, the financial data in place and timely, then either you won't be able to take advantage of some of those, or it's just going to be a quicker mess. It's not going to be really of value. So this is the best place to start if you aren't there just yet. So here are five metrics that I would recommend tracking if you're not already. And it can be a little overwhelming trying to decide what am I going to track? What are the important things that I need to keep an eye on? And I would just say pick a few, maybe 3 to 5 if you're not tracking anything yet. So here is cost per barrel. So that's total production cost divided by barrels produced. Gross margin, so we talked about that. Revenue minus your cost of goods sold divided by your revenue. And that's before your overhead costs, because that'll be something else that you can keep an eye on. Cash runway, we talked about. Inventory turns and margin by channel. So you can also look at margin by, the more detailed you get in your tracking, margin by, right, your specific beers, tap room, distribution, you can break it up like that. And one thing I like to tell my clients is don't get too hung up on having perfect numbers, right? If you're gonna, because that can sometimes just hold you back from actually moving forward with tracking anything. So don't be so concerned that, I might not have every single possible cost in my production cost, right? Maybe I'm missing something there. Start with what you have, just do your best, and then stay consistent. So just stay consistent with what you're using as that number. And where you start to see the value when you're tracking these isn't just the first month you do it, but it's the trend. So it's by tracking it month over month, it helps you see things before they become a big issue. So you can start to see, oh, my inventory is slowing down a little bit, right? And then, so that's going to be a cash issue. We're holding on to more inventory. Your cash runway, you start to see that that's getting tighter because your monthly expenses are going up. Maybe we have to look at overhead, right? And see if there's something we could be spending less. Maybe we have to dial back our marketing expense, or look to see what our labor costs are that are not tied to the production. So those are some of the things that we'll want to be tracking over time. And that's what's going to help you make more informed decisions as you go. Because seeing a trend in your numbers, it gives you confidence in your decision and in what you need to do. Does anyone track any of these? I'm curious. Yeah? All? Some? Okay. All right. Yeah. Would that be hard to track, do you think? Yeah. So that could be another one. Are there any not on here that you'd want to share that you do track?
We do the cost per barrel by brand, cost per barrel by package.
Okay.
Distribution by brand, the gross margin by brand.
Is that one of your key metrics that you look at? Yeah. Anyone else? Anyone else track anything that's really valuable to them or that you wish you could track?
When you say by market, by channel, that like you said, you have like 500 tons of beer stout.
Yeah. Yeah, you could break it out however you'd like. It could just be tap room distribution, but then you could continue to break that out. Because if you're breaking it out by beer, then you're able to say, which is my non-performer, right? Which one should I just pull out? Which one's like the one that's bringing down my profitability? So that helps with that decision making. It might have the logo that you love, right? It might be the one that you worked the hardest with, or that you personally love, enjoy the most. But then when you see it in the numbers, it might be a little easier to let it go, right? Or put it on the retired list, or bring it back later on.
Margin by distributors.
Yeah, margin by distributors. Yeah. Anyone else have anything you want to share? But yeah, it's just getting started. It can be overwhelming trying to pick so many, but even just 3 to start out with, and then continuing to track those can be really powerful. So if we look at a health scorecard of the 2, black ink has inventory control, cost visibility, channel margins, cash management, and red tie doesn't. So when we look at the 2 stories, the difference here is really the financial visibility. And again, it's not that black ink in this example is doing everything perfect. I've never seen perfect accounting. Accounting is just numbers that are representing humans and the things that we're doing, and everything keeps changing, right? You have a new supplier, you have a new POS system, so you're always, there's always changes and improvements that you need to make, but it's making it a priority and having your whole team on board with that. Not just in breweries, but in all businesses. What we see is when that tone from the top, when that message from owners is that this is important, I'm looking at these numbers, it really shifts the whole dynamic, because it means that, people who are purchasing ingredients, they can't just do whatever they want, right? They can't just buy an unlimited amount. They're going to be questioned about it. They're going to be held accountable. And when no one thinks that anyone's looking, then there's a lot of and a lot less controlled, and that's where we see not just profitability go down, but I would also warn fraud. So there's just too much of an opportunity when there aren't controls. So which brewery feels more familiar? You know, I think there's attributes of both, you know, that you might find are part of your brewery, since we all can, you know, make improvements, and there's all things that they're all doing that are wonderful and great and that have gotten you to this point. These are the metrics. So anyone who's interested, we'll send the presentation to afterwards, but those are the actual metric formulas. And just to kind of bring it home, when we talked about the inventory turnover and that cash, the impact that it has, here's an example. So let's see if I got my little pointer. So in this example, cost of goods sold, 1.2 million.
Is that for a full year?
Yeah, yeah. Average inventory, 400,000. So inventory turnover would be 3 turns. Inventory would turn over 3 times in a year. Now, if inventory could be reduced to 200,000, then that means inventory turns over 6 times in a year. And the impact that that has is an additional 200,000 of cash that's available to the business for operating throughout the year. That's the type of impact. Imagine if you had an additional $200,000 throughout the year, right? That would mean maybe hiring someone that you need, not letting someone go, investing in improvements in your tap room, right? Increasing the space that you could be serving people. So there's a big impact there. So key takeaway, inventory isn't just beer, it's cash. Okay, now we're gonna bring Kate in, who's gonna tell you about some great tax credits.
I think I'm gonna sit, but I'm gonna
Yeah.
use this, just look a little bit. Okay, I know we're reaching the appetite for numbers, so I'm gonna go pretty quickly, but there's a lot of information in these slides, and I am happy to divulge any information that you want after the presentation, or take my card and we can have a conversation, but 4:30 right before happy hour, I know there's only so much more I can ask of this group. So we would be remiss if we don't talk about the one big beautiful bill, or the OBBB. I can't believe that that doesn't spell out Trump, not to get political, but I thought for sure that that would be weaved into it somehow. Came out in July 2025, and it had sweeping impacts for this industry and really taxes at large. We're also going to go through some key New York State provisions, but the New York State stuff didn't really change all that much, so I just want to make sure you have the information. There's a ton of changes through this. It's probably a couple thousand pages long of tax legislation. So I'm just going to touch on a few things. The biggest thing that the OBBB did is to really make permanent some provisions that were either already in place or were about to sunset. And it also retracted some stuff that was sunsetting. It's sunsetting a little bit quicker than it was planned to, but definitely an opportunity here. I'm going to touch on 4 of the provisions. 2 of the provisions specifically deal with capital expenditures. So how many people are, in this industry buying new equipment, potentially buying a new facility, making those capital improvements, whether they be a new line for canning, a new tank, that sort of thing. So those are capital improvements. And the Section 179 provision and the bonus depreciation, those are specifically related to those capital improvements. If you're thinking of your numbers, you take that tank and you can't from a tax perspective, you can't expense it all in 1 year, right? You spend $10,000 on a tank and you're going to amortize that over the tax life of that asset. Well, these 2 provisions potentially allow you to take 100% of that deduction in the current year to kind of line up, you're spending the whole money in the current year, you're lining up that expense instead of taking 1/10 of that for the next 10 years over a depreciation basis. So we'll talk about those. The R&D, which is technically called R&E right now, there's been some significant changes to that. We're going to get into that next. And then the excise business loss rules have become permanent. Those were scheduled to sunset, but those have become permanent. So we'll talk about everything on the slide. I wanted to break it down a little bit because I think a lot of people sit in these presentations and say, my brewery isn't turning a taxable profit right now, so how can this help me? Because you're not lowering I don't have income taxes to offset that, but what else can I do? Specifically, the research and experimentation, which is the R&D, that can be used if you're defined as a small business. And from this perspective, small business is $5 million or less in receipts, and taxable receipts for less than 5 years. So in this industry, that affects a lot of people. Those can be used potentially to offset your FICA or your payroll taxes from an employer perspective. Something that everyone has
all year long, so you don't have to wait until the end of the year.
Exactly. So you don't have to wait till the end of the year, and you don't have to be trying to offset income taxes, which you may not have. So that's huge. The bonus depreciation can take that, any income, to zero, and it can actually create a loss that you'll be able to carry forward. So that can make it won't give you a refundable tax credit, but that will take your income to zero, and the NOL, which is created with that loss, will carry forward. From a for-profit or a business that's making profit, obviously the R&E costs can be used to offset income taxes, and this allows you to take both bonus and 179, which are those accelerated methods of depreciation. The one caveat I'll say here is that bonus is a federal program only. So everyone in New York State will have that amount added back from the New York State perspective. Section 179 is mainly with New York State, so it's the federal and state approach. But again, only applicable from a income perspective. Probably the biggest thing from my perspective that happened for this industry out of the OBBB is this experimentation and research line. Now, I know we all sat through Bob's presentation this morning and probably heard it a little bit differently because we all have a bias on what we're hearing. I heard his first 10 years were R&E, right? And he's trying to make a new beer that nobody's making over here. He's probably using hops that the guy next door is not necessarily using in a method that maybe he's not using, that sort of thing. That can fall under research and experimentation. So I think that's a huge credit that the smaller breweries don't necessarily think they're eligible for, because they don't have, number one, that mindset that they are doing research and development. They don't know what they need to track, which would be those supplies and the payroll costs, that sort of thing. And they don't think of themselves as a manufacturer, which you definitely are. So trying to switch that mindset for a lot of breweries, I think is important to try to say, is what I'm doing within my walls falling into this R&E category, and what percentage of my brewer's time falls into this, what percentage of my materials time falls into this. Now again, a lot of it's going to come down to documentation. That's the first question your tax accountant's going to be. So we're going to look to
all year. We want to be tracking that.
Yeah, exactly. We're going to, I have clients that are like 2 months after the fact, we're ready to file a tax return, and they're like, well, tell me what you need for research and experimentation. I'm like, I needed you to track time throughout the year, not necessarily from a timesheet perspective. I'm not looking for, we track our time by the 6-minute mark. I'm not looking for that, but some sort of justification for your brewer's time or, the lab guy's time, that sort of thing. But coming back to this, the biggest change coming out of the OBBB is prior to this act, R&D was required to be amortized over 5 years. So you capitalized it and you amortized domestic R&D over 5 years. The provisions of the OBBB allows that to be immediately expensed again, which is a huge number, especially if you have a lot of this type of activity going through, and it's allowing you to go back and recapture what's been hung up on your balance sheet, so you can either amend your 22 to 24 tax returns, you can take it all, catch up in 25, or you can take it over the next 2 years in order to get back to that 100% rate that would have been in place, and it's 100% going forward. So huge number for a lot of people, and something to keep in mind. Again, this really just kind of walks you through what was the law in 22 to 24 and what is the law now. There are caveats to amend. You have to be less than $31 million of average gross receipts, which I think almost everyone is at this level. So certainly something to keep in mind if that number is impactful for your financials. Again, just a little bit more information on the R&E. We can talk about this, but I put a couple examples here. So like if you have a new canning technique, if you're experimenting with hops, like have that conversation with your CPA in terms of, does this count? Like, does this count? Does this meet the 4-part test? That's the biggest advice I can give you there. The bonus depreciation, again, this is just a method if you're purchasing capital expenditures, instead of amortizing them over, the life of that asset, you can 100% deduct them if they are qualified property placed into service after that January 19th, 2025 date. So you'll see in the prior Tax Cuts and Jobs Act, that number would be ratcheted down 20% a year, was supposed to expire in 2027, so that accelerated depreciation would have gone away. That bumps back up to the 100% and is made permanent at this point. Really just a little bit more information. So qualifying property is defined as non-residential real estate tied to manufacturing, refining, or production. You're allowed to 100% take that deduction in the current year. There might be an example that you'll break up part of that facility depending on what you're using it for, so that's certainly a conversation that you'll want to have with your CPA. Bonus depreciation, again, this is just another method that is able to be used to take that expense quicker than if you're taking it over the life of that asset or over the life of those assets. Again, certainly some qualifications related to that on the next page here, but at the end of the day, you're going to take a full cost of that expense in the current year, which is going to lower your taxable income, improve your cash flows, and really give you an option of what do I do with that money that I was going to pay tax, pay down some debt, utilize it. Last item I was going to talk on the OBBB is just the excess business losses. So this was set to sunset in 2028. Again, that just deals with what business losses you can use to offset other income from a pass-through perspective. You don't lose that income for the loss, it's just carried forward in an NOL format. If it goes above that, I should go to the last page, the 313 from the signal aspect, or 625. And then the last item I was going to talk about from a federal perspective is the QBI. So this isn't new, but it has been made permanent. It was set to sunset in the next few years. And again, this is just a deduction for pass-through entities. So a pass-through entity would be if your brewery is set up as an S corp or a partnership or a sole proprietorship, something that the income is picked up at your personal level, your 1040 level, to a C corp that's paying the tax at that level. So a C corp pays a flat 21% tax rate. An S corp or a partnership or pass-through entity really pays it at that graduated rate of the owner, right? So if you're at that 39.5% rate, which is the top rate, then you're paying income tax on your business income at that higher level. And the QBI was really aimed at trying to level that playing field of, you're making money, it's going to a pass-through, but you're paying a higher tax rate because it's going to a pass-through. So this is an automatic 20% deduction that comes off that QBI income. It's part of your K1. You'll see it there, and it makes it permanent. And also puts that small minimum, and you have $1,000 or more QBI income. There is a small threshold that $400 you'll definitely get, and then it goes 20% above that. But it makes it permanent, which is and then this is just a slide with the key takeaways. I'm not going to go through it because we talked about most of that. The only thing that I am going to touch on here is that salt path deduction, because we're going to talk about that from a New York State income. So the pass-through entity tax is not new, but that is an election, again, from a New York State perspective, or a high tax state, so think New York State, think New Jersey, California, some state that had a high income tax from a state perspective. When the SALT deduction went from unlimited to $10,000 as part of the Tax Cuts and Jobs Act back in 2017, those high states we're trying to figure out a way of, my brewery owner is paying so much more on their income taxes because it's being taxed from an individual level, but then they're not getting the federal benefit because that's getting capped at $10,000. So New York State and a few of the other states have come up with this workaround in response to the federal cap. Now the federal cap at this point has gone from $10,000 to $40,000, which has helped a lot of people. That did not take away the PTAC program though. So this is an annual election that you can make, and it's essentially allowing the brewery or your business to pay your New York State taxes at that corporate level. And that flows into your personal tax return, almost like you have, if my brewery makes $100,000 and I'm 100% owner on that brewery and I want them to pay my tax, I'm paying probably $10,000-ish from an income tax perspective to New York State. That's going to be an expense at the federal level, and it's almost like that $10,000 is going to be in my New York State piggy bank when I go to pay my taxes on an individual level. So it's almost like an estimate that the corporate has paid for me, and it comes through on my K1. Sort of circumventing the fact that now I have $40,000 that I can take as the SALT deduction if I'm itemizing, and I have this $10,000 because it's already been paid for me, if that makes sense to you. So certainly just one more method to try to get around the taxing, or the itemized limitation. It is an annual election. It should have been made on Monday, so don't worry about it for 26. But 27 and going forward does come with quarterly tax payments, and it's just an election that's done on the New York State website. The New York State investment tax credit. So this hasn't changed. It's still part of the New York State budget. Continues to be available. This is probably a flat 4% for most everyone, because that's the limit for a manufacturer from a pass-through standpoint. So S corps, partnerships, sole proprietorships. One thing to keep in mind for this credit is that you can't use both this credit and section 179. So 179 and this are not allowed to be used together. Bonus and the ITC credit are allowed to be used together. So just one more caveat to keep in mind, but this is a big credit if you are, again, doing those capital expenditures, the investment in the tanks, the equipment, that sort of thing. Because you're a manufacturer, this is a great credit to take advantage of from that standpoint. I think everyone knows about the alcohol beverage production credit, which is really just your excise taxes coming back to you from a corporate perspective. Again, this does go on your corporate return and will come back to you probably through a K1. And then the last item I was going to talk about is the farm workforce credit, which is that $1,200 credit. There's been no change to that, but it's available through the end of this year. So I went through that pretty high level, but we can certainly talk about that or anything else. If you guys have questions for us, we'd love to have a conversation. I think we have a little bit of time left, but I heard some clapping next door, so I don't want to take away from happy hour either.
Is there anything else New York decoupled from besides bonus depreciation? And can you
What a timely question, because not yet, but they are talking about decoupling from the research and experimentation. And if that was to go through, everything I've read has been it would be retroactively applied. So the question is, how will they even do that? So we're waiting to see. It's part of, at last check, it's part of the 26 budget that we're talking about right now. So.
And then something I recently discovered that I had missed before was the FICA tips credit.
Oh, yeah.
Can you mention that real quick? Because that's I've talked to a couple other people that weren't aware of it, and it's pretty nice.
It is, and actually, so from a reporting standpoint, that's a very, if you're using a payroll company, that's the easiest credit to go after because they keep track of all of that. So they are essentially, they're trying to, best way to say
the employer taxes that you're paying on those tips, you get back, right? So that you're not paying the Social Security, Medicare on those employees' tips. And so you have to ask your payroll company at the end of the year for their tip credit report, and then you give that to your accountant, and then you should get that right back. Yeah.
Does it go on your scheduled phase, or how does that?
It does.
Yes.
It will flow to a K1.
Yep, so it'll be a credit on your K1 that then goes through onto your personal return.
And it's 7.65% of
Yeah.
the same withholding that would be at the employee level for Medicare and Social Security. So if you had $100,000 worth of tips, it's $7,500.
On the R&E, do you actually have to file any paperwork to sign up for it? Or do you need a written plan? Or if I brew a batch of beer last week and we change the hops out, I can just keep track of that on a daily basis. Like, we have to use new hop in this batch. Is it everything in that
There's a tax
batch?
form that you need to break out.
There is a tax form, and there's
For
really...
each and every
No, just
year.
what you do. So from a audit so from a how do I file it, it's a two-page tax form. It's a two-page tax credit. Whether you're following the spirit of that is really the conversation. So it's not, I've used Cascade hops for all of this, and then I think I'm going to use a blend of this. That doesn't necessarily qualify if you're, I'm trying to think, like if you're using,
We're using Citra hops, but then rather than using the hops, I want to try using Citra extract.
potentially, and it doesn't have to be, this guy's never done, like nobody's done it before, it has to be, you've never done it before.
And would it be it value that entire batch of beer, or is the value of changing ingredients?
It would be the value of the entire batch of beer because it's what you're buying, what you're brewing. And
And
further.
the labor, and the water, and the electricity, and the CO2.
Yeah, the whole thing is a deductible, but all of that goes into the schedule, which comes up with everyone's
So when you're doing your payroll, you can even, have your payroll plan break out into the different departments. You could have the same person that is in like an R, you can create like an R&D department that makes it nice and easy to track. Like, so like the brewer had 10 hours this week
Yeah,
of
or like
that.
the lab guy or
Yeah.
whoever.
If it's a substantial amount, there's also some third parties that we use. Like if you think that it's not so straightforward, but you feel like you really are truly doing R&D, there's some third parties that'll put together and work with you the documentation to fully support that credit that you're taking, from like an audit standpoint.
And audit being like the IRS. So, and that's what I would encourage is to have that conversation with your CPA and they may bring in, there's, I'll call them boutique CPA and specifically look at these sort of boutique credits, like an R&D credit or a cost segregation. Like they will walk you through, tell me about this, tell me about that, write up the packet for you and have an auditable package for you so that it will stand up when and if that number gets picked up. Is the IRS going to come after you for a $1,500 credit? Probably not, but the potential is there and it really depends on the dollar amount.
And it's 20% of the dollar spent, so it's $100,000 batch of beer, take a $20,000 bill.
Potentially, yeah.
And take it early. Like I know, Gusto is one of the payroll companies that I know does a really good job with that, where it's like automatic and you get it, you get that relief throughout your quarterly payroll filings. So if you have a loss, you get to cover that. How much better than not wait until 3 months or 4 months after the next year to get it back? Yeah.
Your tax return. Awesome. Anything else?
Is the depreciation just on newly manufactured equipment, or can I buy used equipment?
You can buy used, depending on what you take, you can buy used. Yeah, it's new to you. Bonus used to be funny that it could only be new equipment, but 179 you can definitely used. Great. All right, thank you.